It's the weekend and you have financial questions that need answering. That can only mean one thing. It's time for Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
Welcome, welcome. It's the Jill on Money show. It's the last weekend before Christmas. I don't know why I said it like that. Sort of feels like that frenzied moment, but I'm not sure anyone's feeling so frenzied right now. It is the last weekend before Christmas. And for those of you who are out and about, I hope you're being very careful. Please, goodness gracious, these numbers are horrible. And we are hopeful that you are taking care of yourselves and your loved ones. We are here to take the mystery out of your finances. Remember, that's our job. Mark and I do this show so that we can answer your questions. And we want to tell you that we are broadcasting from the Capital One Bank virtual studios. Capital One, this is banking reimagined. What's in your wallet? Just like that. I do it very dramatically, Mark, don't you think? You know, by the way, we have a sister broadcast, and it is called, coincidentally, Jill on Money. Isn't that fantastic? So smart, right? And it's a podcast. So I listen to the podcast every day, and I try to listen how I read the spots, Mark. And I'm very competitive. I'm like, I did a better read than so-and-so. So anyway, if you want to subscribe to hear me read those spots, maybe you don't really want to do it for that reason, but it is a daily podcast. You can listen to it whenever you want. And maybe that's easier for you than doing this via radio. The terrestrial radio is great, but you know, you got to make sure you're tuned in at the right time. Maybe you want us whenever you want us. If that's the case, subscribe to the podcast. It's Jill on Money. You can get it on Apple or Spotify or radio.com or Google Play. I don't even know. Does Stitcher still exist, Mark? All right, maybe Stitcher too. Anyway, wherever you get your podcasts, you will find our program, Jill on Money. We have a link to everything on the website at jillonmoney.com. You can check that out. If you have a financial question, however, this is what you need to do. Send us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. Okay, so Russ sent us a note. Subject is annuity or something else. Hi, Jill. My investment advisor at Edward Jones is advising me to buy 3 $125,000 annuities from AIG. 3. Oh, brother. Okay. The advisor refers to it as a hybrid annuity. It is called the Assured Edge Income Builder. And then it's funny because he puts it in quotations, which is actually pretty helpful because he wants to say this is what the marketing is, right? A fixed annuity with a flexible, guaranteed lifetime withdrawal benefit. Okay. Now, Russ says, I was a nervous wreck over the last 10 months, but we left everything where it was, and we have now recovered all the money we lost and more. So everything plus. The annuity is supposed to be a way to eliminate risk to our portfolio as we head into retirement. I think a lot of people are in this situation, Mark. So this is a great question to start the show off with. I am 62 years old. My wife is 61. We have no children, no debt, house is paid for, and we live well below our means. Great. Neither of us work. We live off of our $1.4 million IRA portfolio. It's invested in a diversified mix of medium risk mutual funds, index funds, bonds, bond funds, exchange traded funds, treasuries. Is there something that is equal or better to invest in? All the research I've been doing on annuities leaves me confused, and the majority opinion seems to be not to lock up my money in this investment or an insurance product. I know it's not as simple as a yes or no, or do this, do that, but any advice you could share would be greatly appreciated. Mark, you know, in some cases where you say there is a gray area, not on this. Not in this at all, as a matter of fact. The answer is no, and so that is easy. And here's why. First of all, 3 $125,000 annuities, that's immediately the red flag. So if you want to lock down some of the risk or reduce your risk, all you would do is take some of the money in the IRA portfolio and you move it into less risky stuff. And it's going to be bonds and bond funds and maybe some treasuries. Here's the problem with you for you, generally speaking, is that for most people, that would mean accepting a lower rate of return. In your case, I think it's actually a good trade to make because as you said, it actually means that, when you say I'm living below my means, I'm sure you're not taking as much money out as would deplete your total nest egg. And so I just want to be clear when I look at some of the different annuity costs. I mean, this is essentially about like a 1.5 or 2% a year product. Okay. And I think that I was just looking up, like, oh, I wonder how much the fees are. And of course, it's like so difficult to actually figure out what that is. And I find this to be so annoying because when you look at this, no one will just say, oh, here's how much it costs. They'll say, here's what you could do. This is how much it's going to save, and this is going to protect you. But they don't really, in a very easy way, say, this is the cost. So here's what I think. Say no to this investment advisor at Edward Jones. And then I also would be really interested in understanding why this guy is advising you to invest in something that's going to cost you so much more money than your current structure. It almost leads me to think that he's not a fiduciary and that maybe he's taking a little bit of advantage of you in that he knows you're nervous. He's taking the opportunity of your nervousness to actually sell you something that's probably not in your best interest. So I would love to know more about the actual, the diversified mix. But if you want medium risk, pull some of the money out and go lower risk. It's okay. There's nothing wrong with that. But you know what? I absolutely would not do this. Okay. So there was an easy answer. Glad I could help. Nicole writes that she and her husband are blessed and they make about just under 300 grand a year. He's 50, she's 44. We will max out his 401k and her simple IRA in 2020. We've set aside additional money to reach 15% specifically for retirement. I'm planning to open traditional IRAs for each of us. Neither of us has opened one previously. If I understand correctly from what little research I've done, if he makes a contribution of $7,000 to a non-deductible IRA, $6,000 plus $1,000 because he's over 50, and then he converts to a Roth IRA, there would be no additional tax due on the conversion, right? Because that's a non-deductible IRA and it's a backdoor Roth. So yes. Okay. Now she says if I contribute and then convert to that Roth, there is some calculation which looks at my contributions to the simple IRA. Yes. Yes, you are thinking about that correctly. And I'm glad you love listening to the podcast. But when you have other IRA accounts that are out there, it really makes it more difficult to do the backdoor Roth. So do it for him and then just use a taxable account for the rest. How about that? That's a good way to get there. Okay. All right, you are listening to Jill on Money. If you have a little bit of a break here, right? We're going to go to a commercial break, but you can go to our website, jillonmoney.com, and go and just subscribe to the podcast. And then you'll get us every single day. Just do that right now. See, I told you to do it before. Now I'm going to tell you now. Here's your opportunity. Go to jillonmoney.com, front door, go click on that link, and you can subscribe to the podcast. Okay, we'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It's Jill on Money, and we are answering your financial questions. We're answering your investment questions, your retirement questions. Maybe they're your education questions. Whatever's on your mind, we are here to help you out. The easiest way to get in touch with us is to send us an email. The email is askjill@jillonmoney.com. Now, if you're on the website, if you're poking around our website at jillonmoney.com, we also have a contact button, so feel free to use that as well. Okay, so let's get into more of your questions. This is from Corey. who writes, "Love your show. I just checked my podcast downloads, and the first episode I ever listened to of yours was a rent versus buy show all the way back in January 2019. What a different time that was. Oh my God. Really, it seems like a different universe, huh? I'm really enjoying the daily podcast because we used to do it twice a week, gang, and then we moved to daily for the pod. Thanks for the great content. Anyway, Corey goes on to write, I am 35 years old and only recently have secured a job that provides a 401k or a Roth 401k plan. None of my previous employers have offered the benefit, so I've been maxing out a Roth IRA with First Trade as well as a regular brokerage account with Vanguard. I have $65,000 with First Trade, $110,000 with Vanguard. My question is this. I plan on enrolling in my company's Roth 401k to get the 6% match. And then after that, is there really any benefit in me continuing to fund that account as opposed to my Roth IRA? Unfortunately, I am in the middle of a career change, so my salary isn't high enough to max out both. But my plan was to simply contribute enough to get the company match, then fully fund my Roth IRA and put any remaining savings in my brokerage account. I hope to double my income in the next year or two. Wow, that would be great, huh? And then supercharge the 401k contributions. Am I thinking correctly here? Would there be any benefit for me to do a traditional 401k, given that it's a brand new account, or should I take advantage of the Roth? Also, how am I looking for retirement? Thumbs up or thumbs down? Thanks so much. Cheers. This is from Corey. First of all, it's great that you've done this on your own, okay? I'm not sure why you have a Roth IRA with First Trade. Are you trading individual stocks? Did that make you nervous, Mark? That made me a little nervous. I'm not sure. Because why not just do everything in Vanguard, which is the cheapest? I love the $110,000 is your brokerage account, which is great. You should definitely be using a Roth, not a traditional. I mean, I would use the Roth 401k and the Roth IRA, and I would try to max that out. You have plenty of money in cash. I don't know exactly why. I wouldn't necessarily say that you need to put more money in the brokerage account. Listen, I think the Roth option's much better because, as you said, your income's going to double. Your income's going to go up. So that's what I would do. Okay, Joyce writes, subject, what account is best to draw from for a Roth IRA? Okay. Joyce says, I love the show and I listen every day. So here we go. She says, I transfer $7,000 a year to a Roth IRA. Is it better to transfer from a traditional IRA, meaning that you would convert money from a traditional IRA into a Roth IRA, or should I do it from my long-held investments? I'm 61. I'm in the 22% tax bracket. Okay. I'm worried about owing a lot of tax when I start taking those minimum required distributions when I'm 72. All right. That sounds like a reasonable fear to have. I don't know whether it's better to pay capital gains now from the investment account, which is double what I put in, or continue converting the money from a traditional to a Roth. I have about $1 million in an IRA. It's split between Roth and traditional. I hope to keep working as I'll get a decent pension from my job and keep building the Roth IRA. I would be converting from the traditional to the Roth as long as I'm in that 22% tax bracket. And that's what I would do. And I think that, the 22, because what, as you say, you're going to get a pension. You're probably going to get Social Security. So you want to drive down those required minimum distributions, and you're going to be in this tax bracket, while you do it, which is good. Who knows what's going to happen in the future? I don't know what's going to happen with capital gains, but you've already paid tax on that money. I say convert, and hopefully converting a little bit at a time. Stay within the 22%. It wouldn't kill you if you went to the 24%. It really wouldn't. I don't know how much you earn, because look, 22% is a pretty big bracket. If you're single, it's 40 to 85,000. If you're married, it's 80 to 171. You have plenty of room into the when you go into the 24%, but you've got to have some money to pay the taxes when you do convert it. But I think I like the idea. and converting seems like the better choice in my opinion. Okay, good, very good. All right, next, Michelle writes, "Hi there. My husband and I are both retired, and we're looking for some advice or thoughts. Given the incoming administration," yes, it's official, gang. I've been kind of thinking this is official for a while, but anyway. And given the incoming, here's the statement: given the incoming administration and expected high capital gains tax, should we pay off the mortgage using money that would otherwise earn expected high capital gains tax? First of all, why would you say expected high capital gains tax? We don't know that at all. So I wouldn't do anything based on this idea that you think what's going to happen. First of all, if that two Senate Georgia runoffs result in a Republican Senate, then there ain't going to be any changes that you need to really worry about. Okay. But the bigger question, should we pay off our mortgage using money why would you pay off your mortgage? I would not do that. And stay the course and not, don't pay it off with money from high capital gains tax. Don't pay off the mortgage from an IRA that is taxed as income. Property tax deductions are not expected to go away. They've got 7 years left on a 15-year mortgage. Don't do anything. Michelle, stay the course. Listen, guys, you have to be very careful about making jumping to the conclusion of what you think is going to happen, because I am very, very clear that this is something that, you guys, we don't know what's going to happen next. And it's really much better for you to have a game plan that is set, that you can be clear about, that is not based on what you think is going to happen in the near term. Okay? We don't know. Okay? Mark, you have anything additional to add to that? I never want to think that. And by the way, here's another question from Fred. Is it a good idea to pay off your mortgage early? And the answer is, Fred, we don't know. Tell us more about yourself. In most cases, I'm not a huge fan of this. We're going to have a guest on in the second hour. His name is Michael Goodman. We're going to talk about this question about paying off mortgages. So you'll be able to stay tuned for that. But it is incredibly important for everyone to kind of fight back the emotional pull of paying down a mortgage, because it makes you feel better, and really start to analyze, is that the best use of my money? And what are the downsides? The big downside, of course, being that you lose liquidity, meaning you lose access to your money. That's so vital. So we're going to talk more about this in the second hour. I'm going to tease that again later in the show, later in this hour. But next hour, we're going to be talking about year-end moves that you should be making with your money and some other general topics. And of course, paying down the mortgage, one of the biggies. So you are listening to Jill on Money. If you have a question, send us an email. It's askjill@jillonmoney.com. And during the break, why don't you hop on to the website, jillonmoney.com. You can listen to past shows, or maybe if you miss any part of this one, you can catch up. And you can also sign up for our free weekly newsletter. It comes out every Friday, so you'll be well-versed in the week's events, because Mark does a great job with that. jillonmoney.com. That's the website, and you'll get the free weekly newsletter. Okay, we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and this is the program that is trying to help you make better financial decisions about anything that is remotely connected to your financial life. Could be an investment question, a retirement question, could be a question about paying down student loan debt. It could be a question about whether or not it makes sense to assume that student loan in the first place for your kiddos. These are the questions we love to tackle. If you have a question, just email us. It's askjill@jillonmoney.com, and let us know if you'd like to join us by coming on the air, because we can do that now. Isn't that awesome? Today, we've got Richard from California. He is a recidivist caller. You first emailed us about what?
So back in June, I picked up your podcast and you had said, okay, write in and I'll answer any of your questions. I was questioning it at first. I was like, okay, how real is this? So of course I tried and you responded immediately. So at the time I think it was around $350,000. And with COVID going on, I was still uncertain as to how to position myself. I was going to max out my 401k and my Roth IRA by June. So I didn't know what I should be doing with my money for the rest of the year. And at the time, you gave me some good advice. Here I am a couple months later looking for some more advice.
All right. So tell us what we can do today and also give us some of the facts about your life.
So I live in California, so a little bit higher on the taxes. And I make about $100,000 a year. It's a sales job, so the commissions can kind of go back and forth. But what I'm looking at right now is I have about $127,000 in my 401k. That's a traditional account. And I'm wondering if it makes sense to convert that this year. It'd be at the 24% tax bracket, but I figured I'd have 3 to 4 decades of tax-free growth. And just looking to see what I can do, small moves today that are going to have a huge impact down the line.
You are single also? Just wanted to make sure I understood that. Yes?
Single. I have no debt, no mortgage. I rent a room. I've got a small dog that just showed up in the room right now. So I apologize if you hear that.
Wait a second. What kind of dog? Because that's obviously the most important tell about who you are.
I have a little Shiba.
You got to send us a picture. Come on.
Yeah. Should I just send it to the email?
Yeah,
or
send it to me. Send it to the same email address. Say, here's my baby. So here's the thing. You have a 401k at work. And do you also have a Roth 401k option at work?
So they're opening up that option next year. And I've already signed up to contribute 50% of my paychecks until it maxes out.
Okay, great. You usually cannot do an in-service distribution from a 401k, usually. So I'm not 100% sure, but in most companies, they'll say, you got to leave what you have there. You can't roll it over while you are in service, while it's basically you're working there. But that said, unless you're planning on leaving the job, you can leave that alone and just concentrate on putting all new money into the Roth, which I think would be a great idea for you. As you said, it's great to be in this, 24% tax bracket or 22 or 24, depending on what's going on, and just do it going forward. And at that point, I think, this will get funded and things will go pretty quickly. I'm not sure it's 100% worth it to go through the rigmarole of converting what you have now. I'm wondering also at this point, is it possible that maybe in terms of going forward that you might have extra money beyond the $19,500 to put into a 401k?
Yeah. So I'm already putting aside $6,000 for the Roth IRA. And then usually try and max out the 401k as soon as possible. And it gets me around June or July. Mm-hmm. So then that still leaves me 5 to 6 months of additional money that I get to put into a standard brokerage account.
All right. Well, that's good. So you have some taxable money, which is great. Are you doing everything at Vanguard?
So I do the majority of at Vanguard, but just to scratch the investing itch, I do have some stuff at Robinhood.
Yes, it tries to get young men like you addicted. I know.
Yeah, I mean, for everything. However, I'm not day trading. I usually buy stuff on a quarterly basis.
Okay. And what about the idea of purchasing a home in the future? Is that something that is sort of way back burner? Because you mentioned California, there's a high cost of living there, hot housing market. Is that anywhere in the future, just out of curiosity?
I'm not opposed to living in a rental unit, for the next decade. Stuff might change on my end, but at this point, I'd rather keep putting as much money into retirement, letting it ride, try and get 7%. 8% returns on it, and then figure out what I want to do from there. At this point, I don't mind not owning a house. I don't have that want at this time.
That's great. So I think the game plan is don't worry about converting what you have unless you talk to your employer and they make it very easy to do in-service rollovers, which is a pretty simple question. You can just find out from the HR department, whoever handles the 401k. And again, most companies will not allow that. So you can explain, hey, I just want to move my money out and next year use the Roth. If you can do that, then great. I agree with the game plan. If you can't, don't sweat it. You've got the 401k, the traditional, let it sit there. You'll start the new Roth 401k next year. You've got your existing Roth IRA. And you got the investment account, which is growing, growing, growing. So I think you're in really good shape. So beyond the Robinhood, just out of curiosity, how do you approach investing in the other stuff?
Yeah, so with Vanguard, it's just I let Vanguard self-manage it. And it's all index funds or target date funds. And, it's kind of set and forget. I don't plan on using the money for a couple decades, so I don't mind just buy and hold. So it's a boring strategy, but it's a simple one. I don't mind waiting a couple decades to see what it looks like.
I love your approach. I think it's amazing. I think you're in great shape. So I want to encourage you to, of course, send us a note third time you are allowed on. But I think you're in great shape. I love what you're doing. I love that you're thinking about Roth. I think these are really positive ways to impact your future. And if anything else changes, or if you say, oh, I really do want a house or want some help with other things, feel free to give us a shout. But otherwise, I'm giving you, I'm going to say 4 gold stars, basically. I would give you 5, except for the Robinhood thing. But I understand. It's sort of like saying, well, you have got a little itch and you scratch it and it seems like under control. So 4 stars for you. Thank you so much for joining us, and do stay in touch. Send me a picture of that puppy, okay?
Yeah, will do.
All right, deal. Thanks so much for calling.
Thank you, Jill, and thank you, Mark.
Okay, if you want to join the program live with us and you want to find out what Mark's voice really sounds like, all you have to do, send an email, ask Jill at jillonmoney.com, and let us know, hey, I want to come on the show with you guys. That's not great. So easy. Okay, we'll be right back.
If you've missed any part of a show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back. It's Jill on Money, and we are here to help you understand what is the best financial or money decision you need to make right this minute in your life. Now, look, we're talking about other people's lives. You'll hear me read some of these questions. It might be similar to your situation, but it's not exactly the same. And so I really encourage you to give us a holler just by sending us an email. Ask Jill at jillonmoney.com. Ask Jill at jillonmoney.com. That is what Robert did. And here is the question. Robert says, I love your podcast and I've learned a lot from you. Here's my question. What is a standard range of fees that a financial advisor charges? This is a loaded question. My wife and I recently met with a CFP who works with her organization, and that person wants to become our advisor. He charges 1.3% of our assets that he would manage, as well as, or so on top of that. So it's 1.3% plus $200 a month. Comes out to about $5,000 a year. It seems high to me. I have no problem paying someone for providing services. I just don't know that we'd be getting a good return on investment from working with him. I'm pretty comfortable with managing finances. My wife isn't as much. I mostly invest in passive index funds through Vanguard and Wealthfront. He seems to think we could do better with more active management. And then, by the way, he sends us a picture of his dog. Oh my God, this dog is so cute, Mark. You see this? It's a golden. Charlie the dog is a rescue, and he's got some anxieties that come from his past, but he's a good boy. Thanks, Robert in California. Okay, Robert, I'm with you. I think you don't need to be paying somebody 1.3%. And, I'd be interested to know, what is it that your wife thinks she needs from this guy when you say she's not really as comfortable with her finances? I wonder what it is she's uncomfortable about. Is there something that we can do or you can do, or is there some middle ground where you might be able to give her more comfort and maybe just walking her through this, the current plan you have? It doesn't seem to me like you are the type of person that really needs to be paying all that money. So I agree with you. I'm kind of thinking, keep it simple. Keep it simple. And let's not pile on expenses at a time where you probably don't need that. Okay. Next up, Sean writes, oh my gosh, I'm 19 years old and I've not worked yet. I inherited $1.8 million from my father who passed away 7 months ago. Oh my God. I need to know what I should do with the money. I know I'm lucky to have just received it and I don't want to waste it. I also just moved into my own apartment. Everything is still very new to me. Wow. Don't you want to know a lot more, Mark? Like, Sean, we got to talk to you because you're 19 years old. Do you have a mother? Is there any other siblings? This money was left to you outright. There was no restrictions on it. Obviously you're going to need an advisor, but I'd love to talk to you more about what's going on to help you figure out the best kind of advisor to seek. In talking about financial advice, because we had Robert ask the question before Sean did, look, there's many ways to get advice. You can basically be like Robert. You can manage your own money, and then maybe, you could perhaps get some advice by paying someone by the hour. You could then have something called a hybrid model where maybe it's going to some sort of large institution. So that what would that be like? That would be like, I don't know, like Vanguard or Schwab, Robo like Betterment, and they will manage the money as well as give you some advice, and it's pretty cheap. The next level of management and help and financial advice would be from a place that does a more reasonable fee structure. And there's a lot out there. There's XY Planning, there's Garrett Financial Network, there's Facet Wealth. And then finally, there's like the customizable, like really hold your hand certified financial planner or a CPA who has a designation in financial planning, a PFS designation. And those folks are going to be expensive. I just think that, gosh, without telling you what to do right this second, I would encourage you to follow up with us and maybe come on the air so we could chat with you a little bit about what's going on in your life and how this money, really needs to be managed based on what your needs are. And so, wow, so sorry. Terrible reason to get the money, right? But you have it, and as you said, you don't want to squander it. Okay. All right. Now, Steve writes, I always enjoy reading your column in the Chicago Tribune every Monday. In this week's column, you mentioned converting funds from an IRA into a Roth IRA. Is there a limit to how many times a year one can make the conversion? A few of my stocks have gone south, and I would like to convert them before their prices increase. These are solid companies. They have been hurt by the virus. Can I convert them individually and periodically, or do I get one bite at the apple per year? Merry Christmas and a profitable New Year, Steve. There is no limit at all. You can do this. It's a great idea. And I don't even think you need to worry about the wash sale rule because you're going to convert, you're going to essentially say, I'm going to pay the tax that's due, and then you can just reinvest in the company in the Roth IRA. So I think it's a good idea. Well done. Glad you keep reading the Chicago Tribune. That's great. All right. Now, you are listening to Jill on Money. Oh, and by the way, I should mention that if you are looking for financial advice, one of the great places to seek that advice is napfa.org, napfa.org. Again, if you're confused as to whether or not you could use one of those kinds of financial advisors, give us a holler because sometimes we can talk to you through this and help you make a better decision. Okay, Jill on Money will be right back. You're back. It's Jill on Money, and we are broadcasting from the Capital One Bank virtual studios. Capital One, this is banking reimagined. What's in your wallet? Before we go to the break, we want to get to more of your questions. Remember that next hour, we are going to be talking about year-end financial planning. It's very exciting, really. So you'll want to stay tuned for that. Okay, Scott writes, Hi, Jill. Here's a question from my wife that may be of interest to your listeners. Okay, she is retired and she works part time. She normally generates enough income to maximize a Roth IRA contribution. However, this past March, she was furloughed and subsequently laid off permanently from her position at a local animal shelter. She has a total of about $2,000 in earned income from the position. Since I retired before 2020, I don't have any income myself to help contribute to her Roth. However, she did receive the federal relief funds and stimulus checks, along with state of Connecticut unemployment checks during the ongoing event. We are trying to research if it is possible to count these funds as a way to contribute more than her actual earned income from the animal shelter position. We thought maybe there'd be some type of one-time exception in the rules. Sincerely, Scott. Scott, I don't think so. Unemployment definitely doesn't count. So we take that off the table. The stimulus check definitely does not count. That does not count as earned income. So I think that leaves you with just sort of the boring old, well, I just got to do the 2000. And, it's okay. There's not much you can do about it. As you said, you're retired. Maybe if you got more money that you wish you could put into a Roth and you can't do it now, that's okay. Just put it into a brokerage account or beef up your emergency reserve fund or, I don't know, pay off some debt if you've got some outstanding debt that's kind of nagging at you. But unfortunately, the rules are pretty clear. The IRS has not actually issued anything new on that. And I think if they were going to do it, they probably would have done it already. That is it for the hour, so stay tuned. Next hour, we've got Michael Goodman of Wealthstream Advisors. He is joining us to talk about year-end planning. We'll be right back.
It's the weekend, and that can only mean one thing. You're listening to Jill on Money, the show that takes the mystery out of your finances. Here's your host, Jill Schlesinger.
You are back. It is the second hour of the Jill on Money program, and you know what that means. It means that we have a guest. Yay! And I'm so happy about this guest. Let me first begin the hour by doing some business. We are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. Oh, and don't forget, by the way, Policy Genius, they also have some online estate planning. You might want to check that out. Might as well while you're there. Okay, as promised, we love doing our annual year-end financial planning wrap up with our guest, Michael Goodman. He is the founder and president of Wealthstream Advisors. And I think there's a lot, oftentimes we come on and we all do the same things well, not this year. This year's really going to be unique. So in this first part of our interview, Michael and I discuss some of the opportunities that exist if you actually have a reduction in income in 2020. Most importantly, we're going to focus on Roth conversions. Where should we start when we think about year-end moves to improve our financial conditions?
Yeah, well, it's definitely been an interesting year. There's been a lot of challenges, no doubt. I think the first thing you want to think about is get out of that rhythm or mentality of same as last year. This is a year where it's really important to take stock and review and see what's been different this year for you in order to potentially put yourself in a better financial situation going forward.
So for a lot of people, they may have had a bump down in their income, and maybe one part of a couple lost some income, and so their total taxable income could be lower this year. So let's start with, if you have lower income in 2020, are there some planning moves that you can make right now to take advantage of that?
I think the first thing you want to do is that potential Roth conversion. If you have IRA assets this might be a really good year to convert those IRA assets to a Roth IRA. That amount of money that you convert will become taxable in 2020, and you want to take advantage of this lower income that you had, such that with this additional income, you're still in a low or reasonable tax bracket. You want to make sure you've thought about what tax bracket will it put me in, and does that make sense?
Why is it so important that you have the money outside of retirement to pay the tax that's due when you do start that conversion process?
Using monies from outside of your retirement accounts to pay for the Roth conversion preserves and enhances that all the money that is in the IRA now goes into the Roth, and you're not losing that benefit.
What if you made less money and you've had like too much money withheld for taxes? Is there something that you should be doing differently for next year, presuming your situation's going back to where it was? Should you just leave it where it was? What should you do about your estimated taxes if you've made less this year?
Well, if you've made less this year, the really good news is that you're going to get a nice refund probably come the spring. And I would recommend that you get on top of filing your taxes at a reasonably prompt fashion to get that refund. If you expect your income to go back up again to normal levels for 21, I probably wouldn't make any changes to my estimated payments, because you don't want to get a big surprise at the end of next year that you owe money.
But if you are self-employed, you may find yourself in a situation where you could not make your fourth quarter estimate. Maybe you don't need to, right?
If you're making estimates on a quarterly basis, not with withholding, then you might not need to. But keep in mind that unemployment insurance income is taxable, and you need to make sure that you have enough withholding or monies paid in so that when you get your tax return completed for this year, you don't get a surprise about what you owe.
All right, let's talk a little bit about the remote working, which so many people have done this year. Basically, about, let's say, 25% of the total US workforce is teleworking because of the pandemic. Talk a little bit about what happens when you are working, maybe not in your home, but maybe outside of your city or state of residence. What does that mean? Are there opportunities? Are there problems? What should people do?
Yeah, so it's going to be really interesting to see how this all plays out. There's a lot of people that have sort of left their primary location and gone to another area, maybe to be closer to family or something like that to work. And you might find yourself paying income tax in a jurisdiction that you didn't expect to be paying income tax on. And you might expect not to pay income tax in the place you were in when you were working in the office, but you might still owe that. So this is a really interesting situation that we're going to have to wait and see how it plays out for certain people and for certain places. Some states and or cities could be more aggressive than others on how that gets handled. I think the most important thing you can do here is talk to your employer, make sure that they know where you are and what you're doing. And I would also talk to your tax preparer to make sure that you're aware of any new taxes that you might owe, or any taxes that you might not owe in from the past places you've been in.
You know, one of the funniest questions we keep getting is like people are, rubbing their hands together and thinking like, oh my God, I spent so much money on my new stand-up desk and my enhanced computer, my new iPad stand. I got a ring light. I got all that. And they want to deduct those expenses. Can you explain where things stand for employees and the money they are spending on basically upgrading their home offices? What can they do?
Yeah, for employees, emphasizing that E, meaning that they don't work for themselves or have their own business. But if you're a W 2 and working for another company, there's really not a lot of ways that you can get benefit from deducting those expenses. The thing you need to do is go back to your employer and say, hey, I had to expense these items. Will you reimburse me? And those are deductible by the business, and they should be willing to do so, but I'm sure not all will. But from a personal standpoint and your ability to deduct those expenses on your tax return, that's going to be pretty tough.
Yeah, I mean, the way I look at it, the 2017 Tax Cut and Jobs Act basically eliminated it. You can't do it. you're done, right?
That's right.
So,
Yeah.
but if you are self-employed, of course, you can take a home office deduction, but gang, we are going to use a word here that we will explain to you. Do not be a schnorrer. Michael, would you like to say what a schnorrer is when it comes to the home office deduction and how people should proceed cautiously?
Yeah, yeah. Another way to say that would be don't be a pig about it. Don't overdo it. Do what's proper and correct for yourself there. And make sure you do deduct any expenses you have if you can. If you're self-employed, these are legitimate business expenses if you're buying things to enhance your ability to do your job.
We'll get back to our interview with Michael Goodman in just a minute. During the break, why don't you just go to the website to jillonmoney.com and bookmark it, and then you can go back whenever you want. See how easy that is? All right, Jill on Money. We'll be right back.
Welcome back to Jill on Money, where Jill Schlesinger takes the mystery out of your finances.
You're back. It is Jill on Money, and we are deep into your year-end planning. And we've got a great guest to do this with you. His name is Michael Goodman. He is my pal. His company is called Wealthstream Advisors. He's the founder and the president of it. And in this next part of our interview, the focus is about some of the different rule changes that occurred because of the CARES Act, right? So back in the spring, when Congress passed the CARES Act, the president signed it into law, there was something that was quite noticeable, and that was that there was no need to take a required minimum distribution. And that really was interesting because obviously for people who needed the money, they took money out of their retirement accounts anyway. But for those who didn't take the money, maybe there's an opportunity to do something with that extra money that's sitting in the retirement account. We are going to talk about the qualified charitable distribution in this next part of the interview. But if you're like one of the cool kids like me and Michael, you could just call it a QCD. Here's more of our interview with Michael Goodman. So, Michael, also weird thing about this year, no required minimum distributions. So if people can afford it, how about the qualified charitable distribution in order to get some money out of those accounts without having to pay tax on that? What do you think?
If you need that money, of course, you still should potentially take it, depending on what your options are. But as you point out, Jill, a really good option if you're charitably inclined is to still take that required minimum distribution in the form of a QCD or qualified charitable distribution. That would be a great way to take pre-tax dollars and give it to charity.
Yeah, I know and they need it. Boy, do they need it. All right, let's go to the sort of normal year-end planning stuff. A lot of people have huge gains this year. It's been an incredible and crazy year. What is it about what they should be doing? And so many people are saying, if it's not a retirement account, I don't want to take the gain. I don't want to, start selling stuff, have to pay capital gains tax and start over. What are the options for people who are looking at potentially trying to maintain some balance in their portfolio, but not wanting to pay the tax that's due?
I would say there's a couple of things to consider if you have some gains that you might be inclined to take or think you should be taking if you're overweighted towards something. First is perhaps there's other losses in your portfolio that you can take that will offset those gains. If you were comfortable enough or strategic enough back in March when the market was getting hammered and took some losses at that point in time to rebalance, etc., you might be able to use those losses to offset your gains now. So that's number one to think about. Two is that as we head into year end, there's two ways to think about this. One is I want to take those gains now in my current tax bracket because maybe I'm in a lower tax bracket today, this year. because of lower income or something like that. Or you're fearing that next year there might be new tax legislation that would increase tax rates. Well, then that would incentivize you to take those gains again, like I say, now. The other thing, though, is, we're not that far from year end. And if you feel that next year would be a better year to push that gain off till, you can hang on to that security till after January 1st and sell it then. But keep in mind, you're just exposed to the risk of it during this time.
Yeah, I think that that's a really good point about the tax rates because if you think about it, if you're single, if you're a single filer, you're in the 15% tax bracket for long-term capital gains, all the way up to 440 grand or so. I guess it's 18.8%, whatever. But you know what I mean? That's for some people, this is that weird Medicare surtax. But, so that you could basically be paying long-term capital gains at a 15 or 18.8% rate for a pretty wide swath of filers. So maybe it is better to take that gain at that rate rather than wait around to see 5 years from now. We don't know what the rate's going to be, right?
That's right. That's a perfect example. I think the other thing to consider too is we were talking about charitable deductions a little bit. So if you have positions in investments that have appreciated and gone up in value, those are some of the best things to use to give to charity. A lot of people have heard of this, but too often they just write these checks because it's easier and faster. But if you give these appreciated securities to charity instead of cash, you're completely avoiding paying the capital gains tax on that appreciation. Plus, you get the regular deduction you would get anyway. So that's another thing to think about as we head into year end, and maybe you're more inclined to do it through charity.
And I think that the idea of having some control over your taxes in the future is really starting to hit home for a lot of our listeners who have been asking about that. That goes back to the conversion of the retirement account, but also getting money out of retirement accounts and, sort of avoiding taxes and doing good for others. I'm wondering what you think is sort of the under the radar tax move that we keep missing. What is it that we should be talking more about that we're not talking about?
I do think that number one is the idea of giving those appreciated securities, because I see time and time again where people donate substantial amounts of cash and are paying capital gains in the same year. I think the other thing, also just sticking on the charity theme for a second, is non cash or non security related contributions. You can still donate goods to charitable organizations and get a tax deduction for that. A lot of people, especially now, maybe spending more time at home, are cleaning things out. You give it away to charity. You can take a deduction for that.
But don't like try to fool the IRS and say, yes, I'm giving away my couture clothing to charity and taking, a gazillion dollars worth of donation for charitable and keep good records, right?
Yeah, don't be a schnurrer.
So, Michael, as you look ahead into 2021, tell us a little bit how you see the landscape for the economy and for markets. I mean, what are you preparing your clients to think about as we head into a new administration and a new year?
Well, first thing is, I'm an optimist. So even in these brutally tough times right now, I'm an optimist. And I do think that there's been some good news on the horizon. As terrible as the death rate seems to be and the illness rate from COVID, we do have some good things coming about. It does look like we're going to get a vaccine pretty soon. And it does look like we have a government that does want to continue to support and stabilize the economy. So I think those are two big things. Keep in mind also, the stock market is a leading indicator. That means that when there's bad news, perhaps, and the stock market can react in the short term, what the stock market is really focused on is what's going to happen in the future. If you're an optimist and you believe things are going to be good in the future, well, then the stock market will likely be doing well next year, because it's going to be focusing on what happens as we come out of COVID, not in the worst parts of COVID.
Do you think that there is a likelihood that we are going to see some changes on the tax code?
Yes, frankly, there has to be. And you can play this out, politically if you want to, but I just believe non-politically, the deficit and the debt is just reaching levels that we've never seen before. And you can only do so much economically to come out of that. There's going to be many other levers that have to be worked to get us out of that situation, and taxes will be part of that. The real question is going to be, how fast is that going to happen? Is that going to be a 2021 item or later? And what kind of changes? But you can only do so much so quickly. And I also believe that you don't want to, as we're coming out of this COVID induced economic challenge, you don't want to immediately start raising taxes, because there's this big belief and perception that that will hurt the economy. So I think it's more of a 2022 item, but that's just a guess on my part. I don't know for sure.
Okay, we'll get back to more year-end financial planning. Hey, here is a fantastic idea. When you go to our website and it's bookmarked, because you just did that in the last break, copy that bookmark and send it to all of your friends. Tell them, hey, listen to this great radio show. And if you want to, you can actually subscribe to her podcast too. It's right there on her website, Jill on Money. Okay, we'll be right back.
Follow Jill on Twitter and Instagram for more personal finance content. Just use the handle @JillOnMoney. Now, back to the show.
You're back. It's Jill on Money, and this is the program that attempts to take the mystery out of your financial life. We do that by answering your questions and having really great guests on who also help do that very thing, which is take the mystery out of your financial life. If you have a financial question, send us an email. Ask Jill at JillOnMoney.com. That's askjill@JillOnMoney.com. Now, here we are coming towards the end of the year, and it seems like a long time ago that it was the spring and stock markets around the world were in free fall. And in fact, the whole reason why Mark and I decided to make our twice a week podcast an everyday podcast is that we got so many emails from people who were freaking out. Now, this radio show has always been just a weekend show. Who knows? That could change in the future. You never know. But what's fascinating to me is at that time, we heard from a lot of you who were so scared and you just blew out of the stocks. Not a lot of people who did it, but there are certainly a good handful. We prevented some people, but there were probably too many of you who just get out. Now, here's the problem when you get out. Even if you were smart enough to get out at the tippy top, let's say you got out on February 15th, how would you know when to get back in? It's hard to get back into the market. So it may be that you've got some extra cash sitting around, or maybe it's not even that you sold something, but that you were just scared to commit new money to the market. And then all of a sudden, market starts going up, roaring up 60% since the springtime. And now I know what you're thinking. You're thinking, I don't know how to get in at the top, but I don't know if it's the top. And you don't know if it's the top. So in this next part of our interview with Michael Goodman of Wealthstream Advisors, we want to really try to focus on how do you get back into the market if you've blown out. Here's more of our interview with Michael Goodman. I mean, if you really believe long term that taxes will be rising in the future, does that suggest that you are tending to lean towards Roth options, paying your taxes at these rates now? You know, again, presuming you've run the numbers and worked with your financial planner and done all the things you're supposed to do, is that essentially your position with your client base?
It depends on the client, because I think what a lot of people are missing the boat on is that the Democrats have said we're only going to raise income taxes on people that make over $400,000. You might be making that kind of money now. In retirement, you might not be. So to pay all these taxes today on something that would probably be coming out a lower bracket in retirement anyway, I think you have to really think through what my bracket's going to be now and in the future. And will I have income levels at that height?
So, Michael, way back when, I believe it was March, I included you in one of my CBS Sunday morning pieces, and the market was in free fall on the downside. It was so scary. And at that time, I think a lot of people completely panicked. They did the wrong thing, they sold. Now we have a more than 60% recovery in stock prices. What can you tell people that have been sitting on this cash? How can they get back in without feeling like jerks or whatever? Like, the past is the past. How do we get them back in?
Yeah, it's really difficult because you're so focused on this concept of this run up now, and I missed that, and that's stressful. And am I getting in at the right time? And is it now the top? And is it going to go down from here? I understand, I really do. What you have to do, though, in this instance, is really forget about the past, forget about what happened, and only focus on what your goals are going forward. Is this money that you're going to invest for a long period of time such that it really doesn't matter what happens next month or even next year? And then pull the trigger. And it doesn't have to be all or nothing. It doesn't have to be 100% in or out. Just put in a little bit every month in a disciplined fashion or every quarter, just automatically. Don't look at where the market is. Just keep adding. The wealthiest people that I meet have always just consistently invested and stayed the course.
And so let's go to another area of great interest. We have 30-year fixed rate mortgages at all-time lows. And yet, Michael, I still get so many questions from people. Should I just pay off my mortgage? And I mean, I have a 3.5% mortgage as if it's like a very expensive one. I think that this is one of those similar kinds of situations with trying to get back in the market, that you're telling yourself, or there's some emotional pull about, I want to pay down this mortgage. Talk to folks about how they can determine whether or not they should be thinking about paying down their mortgage or keeping that money invested or in savings or wherever it is. What are the ways that you think about that decision?
Yeah, so if you're a really conservative investor and there's no way you're going to re-enter the stock market at any point in time in the next several years, and all you're going to do is keep your money in cash or in short-term bonds or something very conservative, then yeah, maybe for you it does make sense. Maybe you'll sleep better also, which is a very important part of the equation. But if you're a person that long-term is probably going to get back invested in the market, who's going to probably have a diversified portfolio that has a potential return higher than mortgage rates are today, then most likely it doesn't make sense to pay down your mortgage. Most likely it makes sense to build that diversified portfolio and let it grow, and it will probably do a lot better than what mortgage rates are today.
Add in the complication that if you're getting older, how, you paying off your mortgage when you're 52 may seem like a great emotional relief. But if you're 67 and you have a paid off house, but you need liquidity, you need money, what do you do? What about that situation in the future? How do you frame that conversation?
Yeah, that's a really good point in the sense that a lot of people are so focused on not having debt and having this asset. And some people, I believe, overvalue the value of their homes. There's nothing like liquidity or money that you can use. You can't just tear off a piece of your house and take it to the store. So the idea of having money in an investment account or in the bank that you can use for expenses and or opportunities or emergencies is critically important. I don't think that the idea of having a paid off house always makes sense mathematically. It surely does emotionally, but maybe not mathematically.
Okay, we've got one more segment with Michael, so stay tuned. Everything's cool. Just remember, if you have a financial question, if you want to know how to get back in, or your situation is particularly different, send us an email. Ask Jill at jillonmoney.com. Okay, we'll be right back.
If you've missed any part of a show or want to check out a past show, go to jillonmoney.com for more great personal finance content.
You're back. It's Jill on Money. And we are trying to get you very hyper-focused on these next few days before the end of the year. You know, there's a lot of deadlines that are calendar year end. And it's also a great prompt. I just think that end of the year, even beginning of the new year, it's a good time for you to really consider your larger goals and objectives. You know, that whole financial resolution thing. And I'm not saying like just writing that resolution down is going to make it happen, but it does help if you have specific goals in mind. And we do know from lots of research that people who have goals and objectives around their financial life, when they actually put them pen to paper and they make them specific and achievable and measurable, that those people actually reach their goals more than the others who don't. It just kind of makes it's common sense, right? Okay. So, in this last part of our interview with Michael Goodman of Wealthstream Advisors, one of the things that I'm always fascinated with is how many of you are writing into us about your own retirement, about when you're going to retire. Mark, you noticed me that recently, especially maybe because I've just had a birthday and I'm in my mid 50s. It just absolutely floors me how many of you actually want to retire in your 50s. And I guess I don't relate to it, but also, I remember when I spoke to our guest, Michael Goodman, when I was writing my book, he really helped me identify some of the big mistakes that people make around retirement. And they may not be as obvious as what you would consider. You know, some people say, oh, they don't take enough risk, they take too much risk, they do. But actually, it's actually a simpler idea than about risk or portfolio management. So in this, the last part of our interview with Michael Goodman of Wealthstream Advisors, we want to examine what are some of the big retirement mistakes that people make. Here's more of our interview with Michael Goodman. When I interviewed you for my book, and I said to you, what are some of the big mistakes that retirees make? You did not even flinch. You said, there's no doubt people tend to retire too early. That's like the big mistake, and they spend too much in those early years of retirement. Is that still the case? Do you still have the sense that that's a mistake that people are making around retirement planning?
Yes, I want to be careful though and not necessarily call it a mistake as much as it is just, I don't think, a good financial move. I don't think people realize how much money you have to be able to be unemployed. Let's stop using the word retirement for a minute and just say unemployed for 30 plus years. You know, when Social Security was first established and 65 was full retirement age, most people didn't live past 65. Now you have people that are living 30 plus years after retirement, and there's an enormous amount of resources that's needed to be available to cover your expenses through that time period.
It's unbelievable, isn't it? Just like the length of time that people are living. It truly is amazing. I am going to be judgmental about it. I think people retire too early. And I mean, I guess it depends what you do. And I do love what I do. But I do think that the real cure all to many retirement woes is to work as long as you can. And, you know, not just you're having fun, like work, keep working. It's good for you. You know, I always do like a back of the envelope help out for folks who are listening. And we used to say a withdrawal rate, like, hey, you know, here's how much money you can pull out of your portfolio, you know, from year to year and not blow through it all. And so, Michael, when you and I were growing up as financial planners and advisors, that the standard would always be a 4% withdrawal rate. I am now very comfortably at the 3%. Should it be lower than that because of the low interest rate environment we find ourselves in?
You make a really good point here about it has to be lower, right? Because if you're an average 60-40 investor, and I'm not saying everybody's 60-40, but that is the most common allocation that I see. So if you're a 60-40 investor and 40% of your money is earning pretty low rates for the foreseeable future, that has to be something that's factored in. That having been said, I'm a big non-believer in withdrawal rates. It's a good back of the envelope sort of litmus test when you first look at something,
Mm-hmm.
but you really have to plug in the math. And a great example of that is if somebody's got great retirement savings, but it's almost 100% in a retirement account and it's all going to be taxable as it comes out. Well, you have to factor that in too, right? If you want to buy a car and the car costs $40,000, it's not $40,000. You got to take out 65 or whatever it is to pay the taxes and then have 40 left over to buy your car. You got to factor that in too.
What is the dirty secret that you have about your own financial life that people would be surprised about? Mark says that he's too cheap to buy brand new headphones that allow him to sound better on our air. No, really, what is it? Share a little of the real Michael with us.
I think that if I had to try to come up with something, it would probably be on a day-to-day basis. I'm pretty fiscally tight with my cash. But when it comes to doing something that's important to me or valuable, I'll give you an example. Like I'm going to go on a vacation with my family. That's where I would probably do it in a bigger way than I normally would, because at this stage of my life, it's not about items or possessions. It's really about experiences. So I try to make those experiences as amazing as possible.
Thanks again to Michael Goodman for coming on the show with us. It's always a pleasure. We'll link to his website at Wealthstream Advisors. And of course, if you have any questions that have come up as a result of this interview, feel free to send us an email. It's askjill@jillonmoney.com. We'll be right back. You're back. It's Jill on Money, and we are broadcasting from the Policy Genius virtual studios. Policy Genius is the easy way to compare and buy insurance. Just go to policygenius.com. It's funny, someone just asked me a question, just a friend who said, how do you decide which car insurance to get? I was like, oh my God, I don't know. I think it's just one of those things where, you actually just get the cheapest one, but just make sure you compare apples to apples, right? So with days to go before the end of the year, a lot of people are thinking about making some charitable deductions. And I was on CBS this morning talking about this, about charity on Giving Tuesday. Sue wrote in and she says, "Thank you for all that you do. I enjoy seeing you on CBS this morning. You mentioned that there is a $300 tax deduction for donations. I'm considering 2 donations, and I'm wondering if the donations would be eligible. One is to PEN America, and the other is to the Michael J. Fox Foundation. We've always made some donations, but never had enough to include on our tax return. So I'm not clear how it would work this year. Thanks so much. I hope you're able to find joy this holiday season, Sue." Oh, Sue, that's so lovely. So here's the thing. It's a $300 total, okay? Whatever you do, this is for everyone. Whether you itemize or not, you're going to get a charitable deduction for up to $300. Has to be cash. I presume the Michael J. Fox is a 501c3. I presume PEN America is also a charitable organization, but you can just check. You can go to the IRS website to make sure that it is an eligible charitable donation that you would be making. But it's a $300 total donation that you would be able to take. You might be able to just, maybe you would give money anyway. It's $300 total. And if you're married, it's $300 total, whether you're married or single. It's a little bit of a weird thing. They usually don't do that. So that's it. Thank you so much for listening. Thanks so much for being here with us. We want to remind you we're always available. Just send us an email, askjill@jillonmoney.com, askjill@jillonmoney.com. Wishing you an early Merry Christmas. Please remember to wash your hands, to wear your masks, to maintain your physical distancing, and please try to do something nice for somebody, whether it's Christmas or not. It is the spirit of the season, and someone needs a little pat on the back. Someone needs your energy to help lift them up. A lot of suffering going on in this country, so let's do that together. All right, thanks for listening. We'll talk to you next week.